Hi friends, DK this side. Do you participate in the stock market? Do you struggle to find the fundamentally sound stocks? Do you find it difficult to find out the fundamentally strong stock or fundamentally strong business in the stock market which can be considered for long-term investment? If your answer is yes, probably this video is designed for you. Today in this video, we are going to discuss a very simple approach to find a fundamentally strong stock by using the Piotroski score. We'll understand what is Piotroski score. In fact, Piotroski score is a simple financial metric that is used to evaluate and screen the fundamentally sound stocks or fundamentally strong stocks which might give a good returns in future. So friends, don't forget to like the video, subscribe the channel, hit the notification bell for updates. Let's begin. The Piotroski score was developed by Joseph Piotroski, who was a professor, accounting professor in Chicago. He devised this method way back in 1997. What he did, he evaluated a company's performance on the basis of 9 fundamental criteria. And those criteria were relating to profitability of the company, liquidity aspect, and operating efficiency of the company. And each of those 9 criteria, if it meets the criteria, then were assigned 1 score. Thus, a company can have a maximum of 9 score on Piotroski score or Piotroski scale. Thus, the sum total of 9 fundamental criteria reflects the company's overall performance or overall financial strength in the business in which the company operates. So, what are those 9 fundamental criteria Joseph Piotroski used to arrive at the Piotroski score of a company? Return on asset, cash flow, net income, diluting aspect of the shareholders' value, capital requirement in the last year, days sales outstanding, which in short form is known as DSO, inventory turnover ratio, debt equity ratio, and current ratio. These are the top 9 criteria that were used by Joseph Piotroski to arrive at the Piotroski score. Each fundamental parameters were assigned with 1 score to ultimately arrive the sum total of Piotroski score, reflecting the overall financial strength of the company in the business. So now let us understand briefly, one by one, these 9 criteria. The first criteria that Joseph Piotroski used was return on assets. This indicated whether the company is able to generate profit from the assets that the company owns. And if the company was generating profit out of its assets, then he assigned 1 score to this criteria. The second criteria which was used was to check the cash flow from the operations. If the company's cash flow from operation is positive, which is a good sign indicating the financial strength of the company. And if it was positive, then 1 score was assigned to this criteria. The third criteria which Joseph Piotroski checked was net income of the company. He checked whether the net income after meeting all expenses on business front is positive or not. If it was positive, he assigned 1 score to this criteria. The fourth criteria was, which Joseph Piotroski checked, whether the company has issued any shares in the past year. If the company has not issued any new shares, which means the company is not diluting the shareholders' value. And if it fulfilled the criteria, he assigned 1 score to this criteria also. The fifth criteria that Joseph Piotroski checked was whether the company is repurchasing its own shares in the past if the company is not purchasing its own share in the past year, which indicates that the company is not returning its capital to the shareholders, which means the company might be needing the capital to infuse in the business or requires the capital for the business. And if this criteria is met, the Piotroski assigned 1 score to this aspect. The sixth criteria Joseph Piotroski checked was whether the DSO is declining or not. DSO stands for number of days sales outstanding. If it is a declining one, then probably this indicates that the company is realizing its sales quite faster and quicker, and which is a sign of good liquidity. And if DSO is declining, then Piotroski assigned 1 score to this criteria. The seventh criteria which the Piotroski checked was inventory level. Because inventory, if it is rising, which means the money is blocked. So he checked the inventory turnover ratio. If this is increasing, which indicates the company is able to sell the inventory quickly in the market, which is also a sign of strong liquidity or good liquidity. If the inventory turnover ratio is increasing, which means it's a healthy sign, and hence Piotroski assigned 1 score to this criteria. The eighth criteria was debt equity ratio. If debt equity ratio is declining, what does it indicate? It indicates that the company is becoming less leveraged, which is a sign of a financial strength. So if debt equity ratio is declining, he assigned 1 score to this criteria. Ninth criteria is the current ratio. Current ratio should be greater than 1. What is current ratio? Current ratio is nothing but the liquidity ratio. This can be calculated by dividing the current asset of the company to the current liabilities of the company or short-term liabilities of the company. When we talk about the current assets, it means those kind of asset which can be converted into cash in 1 year's time. And current liabilities or short-term liabilities are those which are the debts due to the company in next 1 year time. Then what is good current ratio? Good current ratio will vary and depend upon the nature of the industry in which the company is operating. However, as a thumb rule, we can fairly consider 1.5 to 2 current ratio is considered to be healthy. So if the current ratio was found to be greater than 1, Piotroski assigned 1 score to this criteria. Since Piotroski score is arrived considering the 9 fundamental metrics or parameters, which means each parameter is assigned with a score of 1. So the maximum score of any company could be to 9. So broadly, we can conclude that Piotroski score of 8 or 9 could be considered as a financially strong company or financially sound stock of that company. Now the question arises here is whether checking the Piotroski score is enough to choose a stock for long-term investing. My answer would be no, because it cannot be a substitute for a comprehensive fundamental analysis. But yes, this can help us to shortlist the stock based on the Piotroski score, because the stock market has thousands and thousands of stock to choose from this ocean kind of stock market and find out the pulse. Before we begin the fundamental analysis, we can find the stocks which have a Piotroski score above 7 and then do the comprehensive analysis of the market. However, I have found one thing with my own experience, that if you have a Piotroski score 8 or 9, and if you are good at technical analysis to understand the price action in the market, then you can combine the Piotroski score with the technical analysis to design an investment strategy in the stock market. I hope, friends, this small tutorial on Piotroski Score might have given you the enough insight about what is Piotroski Score, how it can be used to your advantage. Friends, give a lot of thumbs up to this video, share this video, subscribe the channel, hit the notification bell for updates. Looking forward to meet you very, very soon.